Welcome to this explainer. Today, we're doing a holistic checkup on LifeStance Health's Q1 2026 performance. We're going to look closely at both their financial vitals and their patient outcomes, figuring out exactly how one of the country's largest mental health providers is navigating a pretty complex healthcare landscape right now.
Let's dive right in. To really understand this, we first need to recognize that LifeStance is a massive player in the U.S. healthcare system. They're actively reimagining mental health care with a hybrid model. This means they offer both virtual and in-person outpatient services, and they cater to everyone, children, adolescents, and adults, stepping up to address a huge, frankly critical societal need for accessible care.
To get a read on their trajectory, we're going to run through a 5-part checkup today. 1. The state of LifeStance. 2. Their Q1 2026 financial vitals. 3. Measuring clinical patient outcomes. 4. Their balance sheet and cash flow. And 5. Future prognosis and forecasts. Let's get to it. Starting with Section 1, the state of LifeStance and how they balance Wall Street with their patients.
Now, public healthcare companies face a really unique, kind of tricky dual mandate. On one side, you've got Wall Street. They've got to make money, right? Generating revenue, driving EBITDA growth for investors. But on the flip side, their actual core mission is to genuinely heal patients and improve access to quality care. It's a delicate balancing act. If either side of that scale tips too far, the whole model basically breaks down.
And keep in mind, they are attempting to pull off this balancing act at a massive scale. We're talking more than 550 centers spread out across 33 different states. This huge physical footprint lets them support a really diverse, multidisciplinary team. Psychiatrists, advanced practice nurses, psychologists, and therapists all working together.
Moving right along to Section 2, Q1 2026 financial vitals. Let's look at the numbers behind the growth.
Okay, so the big takeaway here? Their top line is expanding, and it's doing it fast. Q1 revenue jumped a very solid 21% year over year. They pulled in $403.5 million in just the first 3 months of 2026. Compare that to $333 million the year before, and it tells us something absolutely crucial. The demand for their services isn't just holding steady, it's actively accelerating.
And what's really interesting is that this top-line revenue growth wasn't just them hiking up prices. It was largely driven by pure volume. LifeStance facilitated 2.5 million patient visits in the first quarter alone. That's an 18% jump from the previous year. So that hybrid virtual and in-person model we talked about, it's clearly working to bring more patients through the proverbial doors.
Of course, you can't possibly see 2.5 million patients without the staff to back it up. To handle all those visits, their clinician base grew 11% year over year, hitting 8,349 professionals. And what's actually even more impressive here is that they managed a net increase of 309 new clinicians added just in Q1. You know how highly competitive the labor market is for healthcare pros right now. Retaining and growing that base, that's a vital sign for the company's overall health.
Real quick, before we look at the profit numbers, let's bust some financial jargon. The earnings report leans heavily on a metric called Adjusted EBITDA. If you aren't familiar, this is just a way to measure how much money the company makes purely from its core operations, like treating patients and running the centers. It strips out unusual one-time expenses or accounting factors like taxes and depreciation. Think of it as a clear look under the hood at the underlying engine of the business.
And looking under that hood brilliantly illustrates their operational leverage. Check this out. While revenue grew 21%, their Adjusted EBITDA shot up a massive 48% to $51.1 million. Now, when profits are growing that much faster than revenue, it means the business is getting significantly more efficient. In fact, their Adjusted EBITDA margin expanded to 12.7% of total revenue. They are clearly managing their general and administrative expenses really well as they scale up. All right, on to Section 3, measuring clinical patient outcomes, because looking at the data at scale is just as important as the financials. As we know, financial vitals only tell half the story. Dr. Stephanie Ekin, LifeStance's chief medical officer, points out a long-standing issue in psychiatry. For a long time, patients just didn't have an objective way to track their mental health progress. Not like you'd track your blood pressure or cholesterol, right? But she notes that LifeStance is using a measurement-informed care model to completely change that dynamic. This allows them to track actual quantifiable healing at scale.
So what does the data actually say? Well, they published an outcome study looking at patients who started care between late 2024 and 2025. They used the GAD-7, which is a standard screening tool for anxiety. Out of 140,000 patients tracked, an incredible 79% showed clinically significant improvements in their anxiety symptoms. That is huge.
And we're seeing a really similar success rate with depression too. By tracking progress with the PHQ-9 screening tool, the data showed that 73% of the 150,000 patients analyzed experienced clinically significant improvements in their depression symptoms. This is the proof in the pudding that their massive scale isn't diluting the actual quality of care patients receive.
This high level of successful treatment across literally hundreds of thousands of people doesn't happen by accident. It's supported by a very deliberate clinical delivery model. They integrate talk therapy directly with medication management so a patient's entire care plan is under one roof. They leverage telehealth to make sure patients actually make it to their appointments. And by continuously tracking progress with those GAD7 and PHQ-9 tools, they can actively adjust personalized care over time.
Moving into Section 4, Balance Sheet and Cash Flow. Let's examine their liquidity.
Let's translate one more piece of financial jargon before we dive into these numbers. Free cash flow. This right here is the true indicator of a company's financial flexibility. It's the cold, hard cash left over after all the basic bills, the payroll, the facility updates, all of that is paid. It's the money management can actually use to buy new centers, pay down their debt, or return to shareholders.
And the liquidity snapshot here is remarkably strong. In Q1, LifeStance generated $33.1 million in operating cash flow. After making their investments, they posted $22.3 million in free cash flow. This pushed their overall cash reserves to nearly $195 million sitting right in the bank. That gives them a really healthy cushion against their $262.5 million in net long-term debt. Overall, they're in a very stable financial position.
We can actually see exactly what management thinks of that stability based on how they're allocating that capital. Because they're generating positive free cash flow, they had the flexibility to buy back $49.1 million of their own common stock in Q1. Generally speaking, when a company buys its own stock, it's a massive signal to the market. It shows management is highly confident in their current valuation and their future trajectory.
Finally, Section 5, Future Prognostics and Forecasts. Let's see what Wall Street expects for the rest of 2026.
Reflecting that incredible momentum they saw in Q1, LifeStance management actually hiked up their full-year guidance. They're now telling investors to target up to $1.68 billion in total revenue for the year, alongside an impressive $220 million in Adjusted EBITDA. Let me tell you, raising guidance in the very first quarter is a major indicator that the business is performing even better than they originally planned.
And healthcare analysts? They are responding incredibly well to this updated prognosis. Out of 11 analysts polled by S&P Global Market Intelligence, there's a consensus buy rating on the stock. They've set an average 12-month price target of $10.55, and some analysts are even forecasting the price to hit $13, banking on this continued growth and margin expansion.
So, looking at Q1's rising profits, surging visit volumes, and honestly some highly impressive clinical outcome data, I want to leave you with this final thought to ponder. Can scaling a mental health business truly deliver for both Wall Street investors and the patients who desperately need care? Well, if LifeStance's latest holistic checkup is any indication, it certainly seems possible. Thanks for joining me on this explainer, and as always, keep questioning the data.